But we're beginning to see brewing here a banking crisis. And the question we have to answer is this going to become systemic like Lehman Brothers in 08 or 09? Or, and we're betting on this latter one here, is this more like 1994 when Orange County went broke and that created a crisis to which the Fed responded? We think it's much more like 1994 because the setup was similar. In 93, 94, commodity prices had taken off as we were coming out of that recession. It was an S&L-induced recession, so housing. And the Fed was railing against those price increases with higher interest rates. It was a terrible year for growth stocks, and that's how we would characterize 2022. But when Orange County went bust, that was a sign that the Fed had gone too far.
The cryptocurrency crisis went into high gear early Saturday as Silicon Valley Bank's failure caused some of the industry's core plumbing to go haywire. Stablecoin prices wildly swung, and gas fees soared as investors scrambled to move money around hours after regulators shut SVB amid a run on the bank, which had ties to crypto. It was the second crypto-linked bank to go under this week. Hello and welcome to Money Talks. In today's video, Cathie Wood, CEO of ARK Investment Management, updates about the recession fears and the current market cap of the crypto industry and reaffirms her firm belief in disruptive innovation.
We believe that the failure of Silvergate Bank and Silicon Valley Bank, which just the FDIC put it into receivership today, both of those are telling us a couple of things. One, that, the Fed has gone pretty far and is causing a lot of banks, not just these, difficulties. And I'll describe how in a moment. So we do agree with those who say, well, Silvergate had a concentration of crypto customers, and Silicon Valley Bank had a high concentration of venture and venture-related customers. And so that's all true. But if you look at what has happened here, it is the deposit outflows that have triggered the problem, the crisis. We know that venture capital is facing a bit of a liquidity squeeze. Fewer deals are being done. There is more risk aversion in the marketplace. And so these companies are having to draw down their deposits. Most bank with Silicon Valley Bank. They're drawing down their deposits because they have to. And there are others perhaps at Silicon Valley Bank who are saying, wait a minute, I'm not being paid anything here at this bank, or not paid very much, so I'm just going to put my money in a money market fund until I need it. A lot of banks are facing that latter risk. If you look at the money center banks, the big banks, they hardly pay anything on deposits, and so money is fleeing to money market funds. What's happening in the banking system right now is changing everything from my point of view, from our point of view, and is going to make the Fed think twice about what's going on, and that's a good thing. What I will say is we do believe in the last 2 months that the Fed has been influenced by economic indicators that have looked unbelievably strong. Now, retail sales up 3% in January, month to month. That's like a 36% annualized rate. With department stores, I think department stores were up 17% month to month. So that's like 200%. Does anybody believe that? No. Those are seasonal factors. gone awry, actually. The seasonal adjustment factors expect a cold winter, especially in the Northeast. They didn't get it. So the adjustments that they're making to adjust out the impact of winter are causing crazy statistics. And the Fed has been paying attention to them, clearly, because of how Chairman Powell was talking on Tuesday and Wednesday of this week. He sounded very hawkish. And so the employment report today, likewise, again, still a warm winter. Another strong employment report by some measures. By other measures, the Fed got what it wanted to see. Average hourly earnings up only 0.2%, so 2.5% at an annualized rate. Those are wages. So the wage, the inflation that we have seen is not feeding into wages. We're not seeing that cost push inflation that was associated with the 70s. And the other thing we saw in this report was a decline in the work week, which means the headline report isn't as strong as it looked.
In the aftermath, Treasury Secretary Janet Yellen convened top financial regulators to discuss the collapse of SVB. Not long after, crypto markets went into turmoil, suggesting the more than year-long bear market has entered an even darker phase. There's echoes of the 2008 global financial crisis, when bad news kept getting followed up by even worse news. Though in the case of crypto, which lacks a central bank like the Federal Reserve that can bail out the industry, the question lingers: how will it end?
The S&P 500, this is a month to as of today. The S&P down 6%. And the worst performing sectors, again, the market is beginning to recognize everything I've just talked about in the banking sector. Real estate and financial services both down about 10%. The best performing, consumer staples, down 3%. Industrials, technology, all of them down 3%. So in the fixed income market, we started the month of February at about 3.5% on the long-term bond yield. It went up to 4.1% very recently. Now, as of today, we're down to 3.7%. So a slight increase over the month, despite the Fed sounding very hawkish. We've been very focused on the trajectory of M2. So M2, the growth rate peaked in February of 21 at 27%. And we've been suggesting that if there were no changes in Fed policy, that we would see a decline in M2 for the first time since the Great Depression in the 1920s. And here we are. January was the first negative month. February, the actual number is not out yet, but we know that demand deposits, so checking accounts, are down 4% year over year. So that means that all of M2 was probably down somewhere in the 2 to 3% range, probably closer to 3. So now these declines are becoming more serious. And we've been expecting some issues to show up as a result. Another clue that monetary policy is too tight is the yield curve. The yield curve, so the difference between long-term interest rates and short-term interest rates, is inverted, which means long-term interest rates, which are usually higher than short-term interest rates, are actually lower than short-term interest rates. They got to a little more than 100 basis points or 1 percentage point lower recently. Now, the media is finally picking up on this and talking a lot more about it, trying to figure out what it means. And we've been saying for some time that it means that growth and or inflation are going to disappoint on the low side of expectations within the next year.
So, what are your thoughts about Cathie Wood's prediction? Tell us in the comments. Also, don't forget to like and subscribe. See you soon with the next video. Thank you so much for watching.